Hi everyone, welcome to this month's financial markets update. Well, October proved to be another interesting month for financial markets. Equity markets were by and large higher over the course of the month, but we did see a big sell-off in bond markets, particularly our domestic bond market, which was down over 3.5% for the month of October alone. In fact, it was the worst performing month that we've seen since February of this year. What drove that? Again, we saw the ongoing risks associated with higher inflationary expectations continue to filter into the market, as well as the decision by the Reserve Bank to no longer try and target the short end of the curve and yield curve control effectively, and basically allow the market to dictate where rates should sit as it relates to that side of it. So, that resulted in a pretty significant sell-off in the front end of the curve with yields up over 90 basis points. But that also flowed through into the 10-year part of the curve, which was up over 60 basis points over the course of the month. As I said, the inflationary outlook continues to increase here domestically as it does on a global basis, and that's one of the key reasons why we've seen higher yields, certainly over the last 3 to 6 months, domestically as well as globally, but particularly here in the local market. If we think through over the last 12 months, bond yields are up over 1% domestically, both at the short as well as at the long end of the curve, and that's resulted in negative absolute performance for both the domestic as well as global bond markets. Quite a divergent performance when you then look at equities that have delivered in part over 30% in some parts of the market. Equity performance was reasonably good, despite obviously higher bond yields. Our local market, though, was flat, as you would have expected, as I said, given that sell-off and just how those higher yields were then going to be priced into the equity market. And we did see some negative performance, across the energy, consumer staples, and industrial sectors, particularly here locally. Nevertheless, global markets were materially higher. The hedge global equities was up over 5.5% for the month alone, again assisted by 4% uplift in the Aussie dollar against the US dollar through October, but unhedged global equities were also stronger, up over 1.5% to 2%. Emerging markets were the only laggard and continued to struggle from the challenges that we're seeing in the Asian region, particularly as it relates to China and some of the challenges that are going on there, and that flowed through into the broader performance of emerging markets, which was down around about 2.5% to 3% over the month. Now, when we look at emerging markets relative to developed markets, the relative valuations are actually now becoming quite compelling. And if we were just comparing the forward PE multiple of emerging markets to the S&P 500 as an example, it's now trading at around about a 40% discount to the S&P 500. So a significant divergence for what is normally maybe only a 10 or 15% discount over time. So from our perspective, there is some potential opportunity in that part of the market, but we're probably being slightly more cautious in terms of that positioning. We have maintained a position in emerging markets, but over the last little while we have moderated that. But when we start to sort of see these quite significant valuation discrepancies, it does get us a little interested. But as I said, we'd probably like to see some of those challenges and some of the headwinds that facing China start to play out over the next couple of months, because we don't think that those valuation gaps are going to, as I said, arbitrage away in the short to medium term. So we do think there is some time on our hands as it relates to repositioning. But more broadly, when we think about emerging market, it isn't all just China, and this is one of the reasons why we've been maintaining our exposure in that part of the market. As I said, on the fixed income front, it was a pretty challenging and quite a significantly disappointing performance for fixed income markets. And again, when we think about how we've been positioning portfolios, we continue to be underweight that part of the market, particularly as it relates to treasuries, and trying to maintain as a shorter duration position as possible and introduce more flexible strategies into the portfolio. And we're going to continually look to refine that as we move forward over the next couple of months into 2022, because our core view remains that bond yields will continue to move higher as central banks begin their tapering programs, as official cash rates potentially start to also move higher through the back end of 2022 into 2023. And even though the RBA has noted that there's no change to its policy as it relates to hiking cash rates, we do think there is a potential for high domestic cash rates occurring through sometime in 2023. So all in all, it's going to remain a pretty challenging market environment for fixed income investments. Not only are we starting to see, as I said, the policy framework change, inflationary expectations may also result in continuing high yields coming through as investors and the market more generally expects a response from central banks. And we, as I said, we expect that to begin with tapering programs to the back end of this year into 2022. So all in all, as I said, another interesting month for financial markets. The defensive side of the market didn't deliver. The growth side continues to show some positive momentum as we head into the back end of the year. But again, we may continue to see that volatility being the key element of financial market performance, not only through the rest of this year, but certainly into 2022. As always, if you have any queries about your portfolios, please feel free to reach out to anyone in the team, and we look forward to catching up again next month. Thanks and bye for now.